Bismillahirrahmanirrahim. Assalamu alaikum. I am Syed Akif Shah, lecturer finance at Institute of Business Studies, Kohat University of Science and Technology. The title of this course is Business Finance and the course code for this subject is BS 151. This is lecture number 26 and the topic for today's discussion under this lecture is activity ratios and their uses. Basically, this lecture is in continuity to my previous lecture, and I strongly urge and recommend to the listener of this lecture to go through from lecture number 25 and lecture number 24 before listening to this lecture. The outline of this lecture comprises of the discussion of what are financial ratios, and specifically the emphasis will be on what are activity ratios in large. Let us define a financial ratio. A financial ratio is an index that relates two accounting numbers and is obtained by dividing one number by the other, and this certain percentage is a really productive outcome which enable us to compare the ratio in financial health of the company inside the organization and as well as with the outside the organizations of the same industry. It means that the financial ratios actually helps the financial analyst and as well as different investors who are looking to invest their money in the bonds or in the stock of the companies. They are primarily interested in the financial ratio analysis. So the use of financial ratio is twofold. It is used for different type of comparisons in order to know either the company is performing good or it is performing bad. Number first is its internal comparison with its own ratio over the period of time, and secondly, company makes external comparison or somebody who is interested to invest his or her money in this specific company can make external comparisons of different ratios of the company so that to know whether the investment of that investor will produce certain return or they are going to lose their money. So internally as well as externally, financial ratio calculation and analysis is really crucial. Since this is in continuity to my previous lecture, therefore once again we have taken the Basket Wonders balance sheet for December 31st 2007 for picking up the relevant data regarding the activity ratios. In this specific lecture, the emphasis will be on the activity ratios of Basket Wonders, and beside that we are going to deal in the activity ratios with such kind of formula which required us not only to collect data from balance sheet of Basket Wonder but as well as from income statement. Therefore we have selected or presented the Basket Wonders income statement for the same year which is ending at December 31st 2007. The component of the balance sheet and income statement have already been discussed in my couple of previous lectures. So therefore, in order to know about the mechanism or procedure to make the balance sheet and income statement, you can go to my previous lecture number 24 and 25 for larger details. Here our emphasis will be to analyze the financial statement, which is balance sheet, and the income statement with respect to the activity ratios. Let us discuss the first activity ratio, which is receivable turnover. As I have already explained that this is the blend of income statement and the balance sheet ratios. So therefore it has been mentioned clearly that activity ratios involve the data related to income statement and as well as balance sheet. The first activity ratio is to know about the receivable turnover, and this formula and the formula for calculation of receivable turnover is to divide annual net credit sales of the company by the average accounts receivable. And what does this ratio tell us about? This ratio is an activity ratio. It tells us about the activity of the company, and it indicates the quality of receivables and how successful the firm is in its collection. Like, this ratio enable the investors and as well as the internal management to know about the collection department, that whether they are able to collect their account receivable in due course of time, or they actually failed and ultimately such account receivable turned out to be the bad debts or account receivable which are not collectible, and ultimately the company will have to write off such account receivable. So let's collect our relevant data pertaining to the formula. We need annual credit sales, and this sales is actually part of the income statement. Therefore, we can collect the sales related data from income statement. However, to get the average account receivable data, account receivable is basically our assets, so therefore we can collect this data from balance sheet. And the data pertaining to the annual credit sale is 2211, and similarly for receivable it is 394. Now let us check these data in the relevant financial statement. This is the balance sheet where we can get the related data pertaining to the account receivable, which is 394. So we can collect the account receivable data from asset side of the balance sheet. However, to get the sales related data, we have to go to the income statement. Since this is the income statement we have selected for our analysis, and the net sales data is written at the top of the statement, which is 2211. Therefore, we can conclude that we have correctly picked up the required data to make our analysis or calculate the financial ratio. So after plugging the data in the relevant relevant formula, we come up with the ratio of 5.61. Now what does it mean, 5.61? Actually this value is in times, and it tells us that how many times our receivable turned out into collection. Like in 1 year of time period, let me explain once again. In 1 year of time period, how many times our account receivable turned out into cash or collected. So it is actually telling us that 5.6 times in a year Basket Wonder is collecting its account receivable. Here is another ratio, activity ratio related to account receivable turnover, which actually tells us about the average number of days required to collect its account receivable. So therefore it is known as average collection period calculation, and this ratio tells us about the average number of days required by the company to collect its receivable which are outstanding. Or we can say that this ratio tells us about the average number of days that the receivable are outstanding, or in other way around we can say that receivable turnover in days. In how many days on average company collects its account receivable. So the formula for calculating this average collection period is to divide the days in a year, and we know very well that in 1 year of time period there are 365 days, and account receivable turnover, this data can be collected from our previous ratio, which was calculated like 5.61 times account receivable turnover. So in order to get the relevant data to find out the number of days account receivable turnover, we require the account receivable turnover data as well. As we know that in our previous slide we have calculated the account receivable turnover, which was 5.61. So after plugging the relevant data, we come up with 65 days. Now what does it mean? It means that on average, Basket Wonder, which is the company we have selected to calculate different financial ratios pertaining to the activities of the company. So we can conclude that on average, Basket Wonder in 2007, according to the financial data at the end of December 31st, 2007, on average, Basket Wonder takes 65 days to collect its account receivable from credit customers. I hope the narration has been clear to you that this ratio actually tells to the investors, to the internal management, the activity or average collection period of the company. What could be our analysis or conclusion? The less number of days required by the company to collect its account receivable, the more feasible and attractive it will be. Here is a ratio comparison of Basket Wonder with itself and as well as with industry. We have selected, first column says the year, which is 2007. And this is the year what we have selected as our example. And 2006 and fifth ratio are obtained from the archives of the Basket Wonder, where we have come across that Basket Wonder's average collection period in 2005 was 83 days. However, the industry was 69.2 days. It means that Basket Wonder was poorly performing in 2005 because it was requiring more number of days to collect its account receivable. However, Basket Wonder has improved over the period of time. In 2006, it was requiring 71 days to collect its account receivable. However, the industry at that time was asking Basket Wonder, or the benchmark in the industry was 66 days to collect account receivable in the same industry. 2007 is the year of our example, where we have mentioned balance sheet and income statement, and we can notice that Basket Wonder has significantly improved its collection period, and now Basket Wonder required 65 days to collect its account receivable in year 2007. We can also compare the Basket Wonder performance with respect to the industry, and industry in 2007 was asking or having a set benchmark for the other companies to have 65.7 days of account receivable time period. If any company is nearby the industry average, it means that the company is performing well in the average collection period. Therefore, we can conclude that Basket Wonder has significantly improved the average collection period to that of the industry average. This ratio actually tells us about the collection period of the relevant company, which is Basket Wonder in our example. Let us discuss another activity ratio named as inventory turnout. Now, what does this ratio explains? We have a short narration. It indicates that the effectiveness of the inventory management practices of the firm. It means if there is poor inventory, either there is a poor inventory management in the company or there is a good inventory management in the company. This ratio actually explains phenomena related with inventory management. The formula used to calculate inventory turnout is to divide cost of goods sold by average inventory of the company. Now we know that cost of goods sold is a kind of expense which can be found out in the income statement. However, the inventory is pertaining to the assets and which could be located in balance sheet. Therefore, we have written that such ratios involve income statement and balance sheet ratio. As the year of our study for Basket Wonder is 2007, therefore we can go to check out the cost of goods sold value and inventory value in the relevant financial statement. We have picked up cost of goods sold from income statement and it was 1599, and the inventory was picked up from balance sheet of 2007 and it was 696. Let us counter check. You can also counter check from balance sheet and income statement available in this lecture. Here it is. Average inventory value was 696 and it has been confirmed. And the balance sheet states the cost of goods sold was 1599, and once again this has been counter checked. So let's move ahead towards the calculation of inventory turnout or inventory turnover. Finally, after a simple division, we come up with 2.3 times. What does it mean? Now let's explain the phenomena of inventory turnover. 2.3 times in a year, basket wonder inventory has been transformed into the cost of goods sold, or I can say that the inventory sold out to the customer. How many times in a year? 2.3 times in a year, basket wonder on average sell out its inventory, and it turned out into cost of goods sold. Let us discuss the basket wonders inventory turnout ratio over the period of time, and let's compare it with the industry as well to make our conclusion or inference. Either the company which is basket wonder is performing bad or good. We can see that in 2005 the average inventory turnout ratio of the company was 2.64 times. With the passage of time in 2006, its inventory turnout ratio reduced to 2.44, and then it further reduced to 2.3 as we have calculated in our previous example on previous slide. So this reduction in the inventory turnout ratio indicates a poor inventory turnout ratio or poor inventory management going on in this company, which was also highlighted when in my previous lecture we have discussed the quick ratio of basket wonder, where the results were not coming in favor to the basket wonder in comparison to the industry. So the quick ratio also highlighted that there is some problem going on in the company with respect to the inventory management, and this has been further confirmed with the help of inventory turnout ratio. We can also compare this ratio with the industry benchmark, and the industry benchmark asked us or told us that the inventory turnout ratio in this industry is 3.45, which is the mean value of all the companies' inventory turnout available in this industry. So this is another comparison, which is external comparison. So the external comparison is also not going in the favor of basket wonder. So therefore we can conclude that the the company's inventory management policies are poor and they require to be improved and emphasized. Let's discuss another activity ratio related with the total asset turnover, and this ratio actually explains or it indicates the overall effectiveness of the firms in utilizing its asset to generate sales. And the formula for calculation of asset turnover ratio is to divide net sale by total assets. And after picking the related data from income statement regarding net sales and total assets data is available in a balance sheet, we have plugged the relevant data into the relevant sections, and after division we come up with 1.02 times. Now what does it mean? It means that the total asset turnover ratio, if it is greater than 1, on average, in a generic perspective, I am telling that if it is greater than 1, then we can say that the company is not performing bad at all. However, we need to compare it with the external companies related with this industry, and as well as we can compare the industry benchmark presented by Bradstreet and other financial analyst independent companies like Moody and Fitch. They also provide the financial statement analysis related data where we can compare it with the other industry benchmarks. So it is actually, the result is for total asset turnover it is 1.02. Now let's explain it. It means that if a company utilizes $1 of investment into the company, on average it will leads to the increase in $1.02 in our net sales. Once again, let me explain that if the company increases its total asset by $1, there will be a corresponding increase of $1.02 in net sales. So the greater the ratio, the more favorable total asset turnover ratio is considered. Let us compare the total asset turnover ratio with the company itself over the period of time and then with the industry benchmark. In year 2005, the total asset turnover ratio was 1.01, and then company has improved it to 1.02, and once again it has reduced to 1.02. Now we cannot make any conclusion on the basis of past experiences because the company is having average kind of asset turnover ratio, but by comparing it with the industry benchmark, which is 1.17, then we can infer or conclude that the Basket Wonder is poorly performing on its total asset turnover as mentioned beneath in our inference as well, because this is significantly lower than the industry average. Industry average in 2007 is asking us a company in this particular industry must have 1.17 times of asset turnover ratio. However, the Basket Wonder ratio is quite less than the industry benchmark. Therefore, we can say that Basket Wonder is poorly performing on total asset turnover ratio. This was all about the activity ratios what we have covered, and this ratio helps the investor irrespective of the fact those are bondholders or the stock investors. It helps them to decide either to invest their money in this company or not, and it also helps the internal management in deciding where the company is going and where the improvements sections are. Thank you very much for listening to this lecture. If you have any question, you can ask freely on KCMS or via email. Good luck for the day. Allah Hafiz.